If you feel that something in the economy no longer adds up, you're not imagining it. That feeling, the quiet tension behind optimistic headlines, is not fear. It is pattern recognition struggling to surface. Because what we are living through right now does not feel like crisis. It feels like contradiction. Markets near record highs, unemployment still relatively low, technology accelerating, optimism carefully maintained. And yet, beneath all of it, pressure is building. Not emotional pressure, structural pressure. The kind that does not explode suddenly, but accumulates silently until the system can no longer absorb it. Every major financial collapse in US history followed this exact phase. Not panic, not chaos, but denial wrapped in confidence. To understand why the next crash is not a matter of if, but when, we must step away from headlines and return to something far less emotional. Math, history, structure. Because markets do not collapse because people are scared. They collapse because systems become mathematically unstable. And instability always follows patterns. Right now, we are deep inside one of those patterns. The longest expansion cycle in modern American history began in March 2009. What followed was not just recovery, but transformation. Zero interest rates, unlimited liquidity, asset inflation on a scale never seen before. For years, this seemed like a miracle of modern policy. Crises were smoothed, volatility was suppressed. Every downturn was met with intervention. This bred a powerful belief that markets no longer had to obey historical limits, that cycles had been tamed, that valuation no longer mattered. But history has never punished belief. It punishes imbalance, and imbalance is now everywhere. The most dangerous moments in financial history are not those where everyone is afraid. They are the moments where warning signs are visible, but rationalized. 1929 did not feel dangerous. 2000 did not feel dangerous. 2007 did not feel dangerous. They felt innovative, stable, inevitable, until they weren't. Consider the common thread. In every case, markets were not collapsing because of a single event. They were collapsing because leverage, valuation, and debt had reached levels that could no longer coexist. Triggers only revealed what was already broken. Today, we are once again at that stage. The indicators are not hidden. They are public, quantifiable, unambiguous. Yet they are dismissed because acknowledging them would require abandoning comforting narratives. Let's begin with valuation, the most ignored variable during late-stage cycles. The total US stock market value relative to GDP, often called the Buffett indicator, now sits around 230%. Historically, the average is near 100%. Before the dot-com crash, it peaked near 148%. Before the 2008 crisis, around 105%. Today's level is not just elevated, it is unprecedented. This is not an opinion, it is arithmetic. When the market value of equities grows more than twice as fast as the economy that supports them, something must eventually give. Either GDP explodes upward, or asset prices revert downward. History shows which outcome tends to occur. Now consider valuations through earnings. The Shiller CAPE ratio, which smooths earnings over a decade, currently hovers near 39. The historical average is 17. This ratio peaked near 44 in 1999, near 27 in 2007. Both were followed by severe collapses. Valuation alone does not cause crashes, but valuation defines vulnerability. Highly valued systems do not absorb shocks, they amplify them. And shocks are coming, not because of bad luck, but because leverage demands it. Margin debt remains near historical extremes. Corporate debt has climbed to roughly $14 trillion, close to 50% of GDP. Much of this debt was issued during the zero-rate era at 2 to 3% interest. It now must be refinanced at double or triple that cost. This is not a theoretical problem. It is a cash flow problem. When interest expenses rise, earnings fall. When earnings fall, valuations compress. When valuations compress, forced selling begins. This is how downturns cascade. Add to this the deterioration in commercial real estate. Office vacancy rates remain historically high. Property values in many regions have fallen 40 to 60% from their peaks. Yet loans must still be repaid at face value. Roughly $1.5 trillion in commercial real estate loans mature before 2027. Many will not be refinanced. Defaults will rise, losses will surface, and regional banks, still fragile after 2023, will absorb the impact. This is not fear-mongering. It is balance sheet reality. Now layer in the consumer. Household debt exceeds $18 trillion. Credit card interest rates near 22%. Savings rates well below historical norms. This is not resilience. It is exposure. When unemployment rises, even modestly, consumption will contract sharply, and unemployment is already rising. The SAM rule, which has predicted every US recession since 1970 with no false positives, has already been triggered. Manufacturing remains in contraction. Leading economic indicators have declined for over 20 consecutive months, a pattern last seen before 2008. These are not predictions. They are present tense conditions. What makes this period uniquely dangerous is not any single indicator. It is convergence, valuation extremes, debt saturation, rising rates, falling liquidity, weakening consumers, fragile banks, all at once. This is stage 2 of every major crash. Warnings are visible. Experts explain them away. Markets remain elevated. Then, something breaks. Not because it was unexpected, but because it was inevitable. In the next part, we will examine why timing now matters, why the window narrows between mid-2026 and late 2027, and why central banks are no longer capable of stopping what they once could only delay. Because once you see the full structure, the conclusion becomes uncomfortable and unavoidable. To understand why the window between mid-2026 and late 2027 matters, we need to confront an uncomfortable truth about financial systems. Crashes do not happen when conditions are worst. They happen when conditions stop improving. This distinction is subtle and critical. Markets are remarkably tolerant of bad news. They are far less tolerant of disappointment. As long as investors believe tomorrow will be better than today, Risk is forgiven. Debt is rolled. Valuations are defended. Narratives hold. The moment that belief fractures, the system changes behavior. Not emotionally, mechanically. This is why timing is never about prediction. It is about pressure. And pressure today is building along timelines that are no longer flexible. Let's begin with interest rates, not where they are, but where they stay. For over a decade after 2008, the US economy existed inside an artificial environment. Near zero rates, cheap refinancing, unlimited duration. Debt did not have to be repaid. It only had to be rolled forward. That era is over. The Federal Reserve may cut rates eventually, but it cannot return to zero without reigniting inflation that is still structurally unresolved. This creates a narrow corridor. Rates stay high enough to stress borrowers, but not low enough to rescue them. This corridor is lethal to leverage. And leverage, not fear, is what collapses markets. Now consider the refinancing wall. Between 2025 and 2028, trillions of dollars in corporate debt mature. Much of it was issued when money was nearly free. Much of it assumed perpetual growth. Much of it assumed refinancing would always be possible. Those assumptions no longer hold. When debt rolls over at double the interest cost, cash flow collapses. Companies do not fail immediately. They cut. They delay. They defer investment. They reduce employment. This is how downturns propagate. Quietly at first. Then suddenly. The same pressure exists in the federal budget. US government interest expense now exceeds $1 trillion per year. It is one of the fastest growing line items in the budget. This matters not because the government will run out of money, but because fiscal flexibility is disappearing. Stimulus becomes politically and mathematically constrained. Deficits expand faster than growth. Confidence weakens. This limits the ability to respond forcefully when stress emerges. In past crises, policymakers had room. Today, they have trade-offs. And trade-offs introduce hesitation. Hesitation in policy response is dangerous. Now examine liquidity, the oxygen of markets. Since 2022, the Federal Reserve has been shrinking its balance sheet. Quantitative tightening removes reserves from the system. It reduces excess liquidity. It exposes weak hands. Markets can rally during tightening, for a time, but eventually, liquidity scarcity asserts itself. Every major downturn in US history coincided with declining liquidity. Not always immediately, but inevitably. The reason is simple. Liquidity masks risk. When it recedes, risk is repriced. This is why volatility feels suppressed, until it doesn't. Suppression builds energy. Release is violent. Now combine liquidity withdrawal with valuation extremes. This combination is rare and dangerous. In 2000, valuations were extreme, but debt was lower. In 2008, debt was extreme, but valuations were lower. Today, both are extreme. This removes shock absorbers. Small disturbances become systemic. Now consider market concentration. A handful of companies now represent an unprecedented share of total market capitalization. This concentration has distorted index performance. Most stocks are not performing well. A few are performing extraordinarily well. This creates a false sense of stability. When leadership falters, there is nowhere to hide. Passive funds amplify this effect. They buy what rises, they sell what falls. This is not intelligent behavior. It is structural behavior. And structure does not pause to think. This is why market declines now accelerate faster than in past decades. Selling becomes mechanical. Now look at labor, often cited as the economy's strength. Employment is a lagging indicator. It improves last. It deteriorates last. By the time layoffs rise visibly, downturns are already embedded. We are now seeing early cracks, hiring freezes, reduced hours, temporary employment declining. These signals are not alarming in isolation. They are alarming in sequence, because they always appear before recessions, never after. The timing window matters because cycles overlap. Debt maturity, rate pressure, liquidity contraction, labor softening, all converge within the same narrow timeframe. This is not coincidence. It is arithmetic, and arithmetic does not negotiate. Now address the most common objection. What about innovation? Innovation does not prevent crashes. It accelerates them. Every major bubble was fueled by innovation. Railroads, electricity, automobiles, the internet, housing finance, artificial intelligence. Innovation creates optimism. Optimism justifies leverage. Leverage amplifies collapse. This does not invalidate innovation. It contextualizes it. Innovation changes what survives, not whether a cycle corrects. This is why the phrase, "this time is different," is always spoken sincerely, and always proven wrong. Not because people are foolish, but because progress blinds us to structure. Structure repeats. Technology evolves. This is the paradox markets never escape. As we move closer to the 2026 to 2027 window, the system becomes more sensitive. Smaller shocks matter more. Narratives fracture faster. Liquidity gaps widen. Crashes rarely arrive as single events. They arrive as sequences. A failed auction, a default, a downgrade, a surprise data release. Each seems manageable. Together, they cascade. In the next part, we will examine what the trigger is likely to be, why it almost never looks like what people expect, and how psychological denial delays recognition until it is too late. Because the most dangerous belief in markets is not optimism. It is the belief that one will have time to react. The most dangerous phase of any financial cycle is not euphoria. It is denial. Denial is quieter than panic, more polite than fear, more convincing than greed. Denial sounds reasonable. It says, yes, there are risks, but they are manageable. Yes, valuations are high, but earnings will catch up. Yes, debt is large, but growth will absorb it. Denial is not ignorance. It is selective intelligence, and it dominates right before structural breaks. Because by this stage, too much has already been committed. Capital, reputation, identity. To admit danger now would require reversing years of belief. so the system delays recognition. This is why the trigger for a major market downturn is almost never what people expect. People look for a headline event, a war, a crash, a scandal, a single villain. But systemic crises do not begin with explosions. They begin with failures to roll. A bond auction that clears at an unexpectedly high yield. A refinancing that suddenly costs too much. A counterparty that quietly steps away. Nothing dramatic, nothing cinematic, just friction. And friction in leveraged systems is fatal. The most likely trigger between mid-2026 and late 2027 is not collapse. It is non-renewal. Debt that does not disappear but cannot move forward. Consider commercial real estate. For decades, it functioned on assumptions that no longer hold. Permanent office demand, stable occupancy, predictable refinancing. These assumptions were shattered, not suddenly, but permanently. Remote work did not eliminate offices, it fragmented demand. Fragmentation destroys pricing power. And pricing power is what services debt. As loans mature, many properties no longer qualify for refinancing at acceptable terms. Not because they are worthless, but because the math no longer works. Lenders respond rationally. They tighten, they delay, they demand more equity. Borrowers cannot comply. Defaults rise, slowly at first. Banks do not collapse immediately. They restructure, they extend, they pretend. This phase can last years, but capital markets are less patient than banks. Once losses are acknowledged, even partially, confidence erodes. This is how stress leaks from one sector into another. Now look at sovereign debt markets. US Treasuries are considered the safest asset in the world. They are safe from default. They are not safe from repricing. As supply increases to fund deficits, yields must rise to attract buyers. This is not a crisis. It is a mechanism. That rising yields compete with everything else: equities, real estate, private credit. Capital has alternatives now, and alternatives drain demand from risk assets. This reallocation happens quietly. Indexes drift, breadth weakens, volatility increases. Then something breaks. Not the system, a component, a hedge fund, a regional bank, a foreign buyer, a shadow lender. Once one component fails, correlations rise. Assets that were diversified begin to move together. This is not panic, it is margin. Margin does not care about narratives. It calls when numbers move against positions. And when margins are called across multiple assets simultaneously, selling accelerates. This is where modern markets differ from historical ones. Speed. Algorithms do not pause. ETFs do not reason. Risk models respond instantly. Liquidity vanishes not because people are afraid, but because bids are withdrawn. This is why crashes today feel sudden. The system is optimized for efficiency, not resilience. Now consider psychology. Most investors believe they will see the warning signs in time. They won't. The signs appear, but they are interpreted away. Temporary, seasonal, technical. The human mind prefers continuity, especially when discontinuity threatens identity. Professionals are not immune. In fact, expertise often delays recognition. The more invested someone is in a framework, the harder it is to abandon it. This is why institutional investors are often late, not stupid, committed. By the time acknowledgement occurs, exits are crowded. Retail investors are blamed, but they are usually last, not first. Now address the role of media. Media does not cause crashes, it narrates them, and narration lags reality. Before a downturn, media emphasizes resilience, soft landings, strong fundamentals, healthy consumers. After the downturn begins, the tone shifts rapidly. Suddenly, risks appear obvious, warnings seem prescient, hindsight sharpens. But by then, positioning has already changed. This is why relying on consensus signals is dangerous. Consensus reflects comfort, not truth. Now ask the critical question. If this window is so dangerous, why hasn't the market already collapsed? Because systems decay before they fail. Stress accumulates invisibly, like metal fatigue, like geological pressure, like biological aging. There is no bell that rings when limits are reached, only rupture. The timing window between mid-2026 and late 2027 represents a convergence, not prophecy, not certainty, but probability, high enough to matter, high enough to prepare for, too high to ignore. Preparation does not mean panic. It means optionality, liquidity, flexibility, reduced leverage, psychological readiness. Those who survive cycles are not the smartest. They are the least rigid. They adapt early. They accept discomfort. They prioritize survival over optimization. In the final part, we will examine what comes after the break, not just the damage, but the transformation. Because every collapse redistributes power. And those who understand the pattern before it completes are never the ones asking what happened. They are the ones deciding what to do next. Every collapse is misunderstood while it is happening. People ask the wrong question. They ask, how bad will it get? History suggests a better one. Who does it change? Because systems do not fail evenly. They fail selectively. They preserve what is essential. They discard what is fragile. They reward what is adaptable and punish what confuses stability with permanence. When a market breaks, wealth does not vanish. It migrates from leverage to liquidity, from speed to patience, from confidence to clarity. This is the part most people miss. They imagine collapse as destruction. In reality, it is reallocation. The Great Depression did not erase capital. It reorganized it. The inflation of the 1970s did not end enterprise. It reset assumptions. The crisis of 2008 did not destroy finance. It centralized it. Every rupture narrows the field. Fewer participants, larger players, higher barriers. And this is where individual perspective matters. Because most people experience systemic change emotionally, not structurally. They feel anxiety, uncertainty, anger. They search for blame. But emotion is a poor guide through transformation. Understanding structure is better. Structure explains why certain outcomes repeat across centuries, cultures, and technologies. Debt cycles, liquidity cycles, trust cycles. They are older than modern markets, older than central banks, older than democracy. They exist because human behavior does not change, only its instruments do. The next transition will not look like the past, but it will rhyme. After the break, 3 things typically happen. First, risk is redefined. Assets once considered safe are questioned. Assets once dismissed are reconsidered. Risk stops being about volatility and becomes about dependency. What depends on refinancing? What depends on confidence? What depends on constant growth? Anything that requires ideal conditions becomes fragile. Second, time horizons lengthen, speculation fades, cash flow matters again. Durability is revalued. This is when patience becomes an advantage, not a personality trait. Third, narratives simplify. Complex financial engineering loses appeal. Straightforward ownership regains credibility. Not because people become wiser, but because complexity fails under stress. This is when clarity outperforms cleverness. Now consider the individual viewer. You are not required to predict exact dates. You are not required to time markets perfectly. You are not required to win. You are required to remain solvent, financially and psychologically. Most people lose not because they are wrong, but because they are overexposed. Too much leverage, too much certainty, too much attachment to a single outcome. Resilience is not pessimism. It is humility. The humility to accept that systems larger than us will move, whether we approve or not. And that preparation is not fear. It is respect for reality. This is why the most important asset in the coming years will not be information. It will be discernment. The ability to separate signal from reassurance. The courage to stand apart from consensus. The discipline to wait while others react. History favors those who understand cycles early, but act late, who observe calmly, position deliberately, and move when opportunity appears, not when panic demands action. This is the quiet advantage. Not excitement, not adrenaline, not prediction. Composure. And now, before we end, a final thought. If this video resonated with you, it is likely not because it frightened you, but because it articulated something you already sensed. A tension beneath the surface. A quiet instability behind confident headlines. A sense that the rules are changing, even if no one announces it. If that is true, then you are exactly the kind of person this channel is made for. Thoughtful, curious, unwilling to accept simple answers to complex systems. If you believe conversations like this matter, not as entertainment, but as preparation, then consider staying with us. Not out of habit, out of intention. A subscription is not a click. It is a signal that you value depth over noise. A like is not approval. It is support for work that takes time, research, and restraint. And if there is one person you trust enough to have a real conversation with, not about markets, but about what they reveal about the world, send them this video. Not to convince, but to explore together. And if you choose to leave a comment, don't summarize the video. Add to it. Share a thought, a question, a disagreement. Something that tells us you were here, not just watching, but thinking. That is the only kind of audience worth building. Thank you for giving this your time.